You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla. It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
My guest today on Strategy Spotlight is Ken Keating, who is a senior specialist for the OCC Investor Services team. Ken, I know you've got a lengthy history in the business. Thanks for joining us here today. If you could just start by letting us know what is your experience and background in the industry, what brought you to your current role, and what kind of things you're up to today with the OCC team.
Well, sure. Thank you for having me, Ed. Hello, everybody. Once again, I've been involved in the options industry for over 25 years, both on the trading side as well as the analysis side. I started out my career in the early 90s working on the Pacific Coast Stock Exchange out in San Francisco as a floor market maker. I worked for one of the largest independently run, privately held market-making firms at the time. I soon moved to Chicago in the mid-90s, worked as a floor market maker in Chicago as well as a floor specialist. And then I moved back to San Francisco. I ran risk management for the very same firm, as well as running a large off-floor prop vol arb desk for that very same firm. So I left them, ended up working for a capital management company where I also traded an off-floor prop book, as well as working for myself as an independent market maker, quoting on the CBOE as a remote market maker and sole proprietor. And lastly, I left trading after probably about 20 years, and ended up getting into the analysis side, where I was working for two startups where we were analyzing equity and derivative flows for publicly traded companies, basically serving the investor services or investor relations departments within those firms, and making them aware of what was going on with their stocks so they could present good information to their boards. So in a nutshell, that's my career over the last 25 years. Currently, I'm working at the OIC now as an investor services specialist, and I'm just tasked with helping individuals better understand equity options and option strategy.
That's great, and it sounds like you've got a very storied past to talk about, crossing the country a few times, doing different things, and I know your experience and expertise is a huge asset for the investor services team. Ken, you mentioned to me you wanted to talk a little bit about the long straddle of options position today, and we do want to get there. I want to hear your insights and your description for that. Like any option strategy there is, the first thing I always ask my guests is, before we get into the options side, what are we trying to accomplish, or what type of market outlook might an investor have that could lead them to this strategy? So when it comes to the long straddle, how would you answer that question? What is the preliminary forecast or opinion that an investor might have that would lead them to consider the strategy?
Well, essentially, a long straddle is a position that a trader would put on when they're expecting a large market move, but they're unsure as to the direction. So that could be either up or down, but they are entirely unsure of that. So what they would do is they would buy typically an at-the-money call, and an at-the-money put is purchased simultaneously at the same time. So either way, whether a stock makes a large up move or a large down move, the investor can profit. So any time when we have a large market expectation for the stock or index, but we're just unsure of the direction, that's when a straddle would fit us.
Okay, got it. So a large move we're expecting. We don't know which way it can go, but whatever market event is upcoming, we're thinking a big move is going to come, and we want to capitalize on that. You mentioned a little bit about putting it together. It's buying a call, buying a put. So just a little bit more about strike and expiration. Is it always at the money, or is there ever a reason to go away from at the money? And then as far as choosing expiration, what kind of comments would you have on those two selections?
Well, obviously, you want to time your straddle purchase to the event in question. So if you're looking to purchase a straddle for an earnings event, you want to look for an expiration that's beyond the earnings event. Obviously, it depends on your forecast of what the stock could potentially do after the move, too. So, you want to purchase a straddle, but you don't want to go too far out, because obviously the more that you go out, the more time premium you're paying. But you want to pay just enough time premium where you'll be able to take advantage of the time frame as well as the market move. So I was talking earlier about how typically an investor would purchase an at-the-money call as well as an at-the-money put. Well, that's a market neutral strategy. So let's assume that a stock is trading 50, and an investor bought one of the 50 calls and one of the 50 puts that expire in 3 weeks. So every option has a delta. So the delta of this strategy would be zero, because we're long a 50 call. That's a positive 50 deltas. We're long a 50 put, which has negative deltas. So negative 50 and positive 50 is zero. So we have, right at the stock price at 50, we're completely market neutral, but we do benefit from the fact that if the market goes up in a big way, we're long the call, and if the market goes down in a big way, we're long the put. So options have different Greeks, and delta is one of them, gamma is one of them, vega is one of them, theta is also one of them. So when we're long a straddle, we will be long gamma, we will be long vega, and theta, which is actually working against us, that's the time decay, works against us. So if a stock makes a large move in either direction, okay, we will pick up deltas and we will pick up and gamma. So our delta will increase because our gamma increases. So in a big up move, we'll get longer and longer on the upside, and a big down move will get shorter and shorter on the downside. So either way, but we need a big move. And just for instance, if we paid $4 for our straddle, and the stock is at 50, we need a move greater than $4 to help offset the cost of that position. So if we paid $4 for a straddle and the stock only moved $3 and that's where it finished, we would actually lose money. So we're really looking for an expected move that's greater than the price that we paid for our straddle.
Okay, gotcha. Well said. So it's an expiration date somewhat close to after some sort of binary event that we're expecting. I like the way you outline the deltas there. The deltas working in your favor no matter which way the stock moves, but initially there is no delta, so you have to have that movement, which makes sense the way you describe the straddle. You need
exactly
to pick up those deltas in one way or the other. Right. And I want to dig deeper and pick your brain more on those Greeks, the theta and the vega. And of course, this is primary and essential to understand when you're trading options, is both the effect of time decay and volatility changes. So with respect to both of those, time decay, of course, working against us here. So what would you say about that? We're buying options, we're choosing an expiration date, and we have theta working against us. And then the implied volatility factor, I would imagine both of these would play a large role. So can you just expand the exposure we have there and what we need to be looking for with respect to the time decay and the time frame we've chosen, and then the implied volatility changes?
Absolutely. So once again, if we are long a straddle, okay, we are going to be, in terms of vega and theta, we are going to have positive vega and we are going to have negative theta. So obviously time is working against us. If the stock just sits at 50 in our 50 straddle example, if the stock just sits at 50 and does nothing, we're going to lose a little bit of money every day due to that time decay up until expiration. And options start to decay more rapidly 30 to 45 days out. So that theta isn't linear. It's more exponential. It actually decreases at a greater rate the closer we get to expiration. Now, vega, on the other hand, is an option sensitivity to a change in implied volatility. So because we're long vega, we're long the contracts, we have long vega, if volatility, for whatever reason, decides it goes up, say the stock is right at 50, and the straddle that we purchased for $4 today, say 3 days from now, for some reason we look at our screen and we say, oh my God, the same straddle, stock hasn't done anything, and the same straddle is trading for $4.25. Well, how can that be? Because I've got time decay that's been working against me, but my straddle's worth more. Well, when that happens, the most likely culprit is the fact that implied volatility has gone even higher. So, people who are long options you could actually profit from implied volatility going up without ever even seeing the potential move. So that's just another factor that works in your favor when you are long volatility. Likewise, on the other side, if you paid $4 for the straddle and implied volatility went lower, you would in fact incur a loss. So it's two sides. There's two sides to every coin, and but if you are long the straddle, long volatility works in your favor if it goes up.
That's very insightful, and considering the way you described this long straddle, looking in both directions, volatility would seem to be a major component to the analysis being done, and that was well described. One thing I've always found interesting when watching TV or reading articles is that economists or market analysts may be forecasting the potential move in stocks after a binary event. As you said, most likely it's earnings, and they'll say, well, the options market is predicting a certain percentage move in the stock after this particular earnings event, and don't really get a description of where that comes from. I know the straddle is involved somewhere, so can you provide an explanation of what they're talking about and what kind of computation they're doing to give that kind of forecast?
Sure. So when you see the the newscasters on TV talk about expected moves and what the expected earnings implications are. What they're really looking at is the at-the-money straddle. Okay, so the perfect example is if a stock is reporting earnings on expiration. So a lot of stocks have weekly options these days. So let's just say it's expiration Friday and the stock is reporting on expiration Friday. Well, if that market is pricing the straddle at, say, $5, okay, it's a $50 stock, the market is implying a 10% move. That's by looking at that $5 straddle and comparing it against the stock price at $50, the market is implying a 10% move. They don't know which direction, but it's implying a 10% move in either up or down. So when you hear the pundits on TV talk about the expected move, that's essentially where they're getting their information from. They're looking at the near-term at-the-money straddle to come up with that expected percentage move.
It's simple enough, like so many things in the options world. When you learn about them, on the surface they seem complicated, but when you hear the explanation like you just gave, it's rather intuitive, and it makes a whole lot of sense. So thank you for that.
Absolutely.
Towards the back end, we've got the position open, we know what we're trying to accomplish and what the exposures are. So now the position is working, the market's moving, the stock is moving. What position management techniques do we need to be aware of, or just from a general sense, managing the position? What do we have to be looking for, and what types of things are at our disposal as the stock is moving around, potentially up or down?
Well, certainly. Obviously, in the example of the $50 straddle, and just say we're long in, we own it for $5, and all of a sudden the stock makes a $10 move, okay? So obviously, say it makes a $10 move to the upside, okay? So now at a minimum, our call that was at the money is now deep in the money. At a minimum, it's worth $10 because we started at 50 and now the stock's trading 60, so it's going to have a minimum of $10 of intrinsic value. So we've already doubled our money on the straddle. So in one scenario, an investor could just take off, sell their call, sell their put if it's got any bid left to it, and just take your profits and look at something else to do. Another thing that a trader might do is they might sell their deep in the money call now and stay long the out of the money put, the untested side, and in a sense, now you've actually paid for the position, you've taken your profits, you've paid for that straddle, you're free rolling that put. You get to have that put, whatever value, whatever time is left in that put, you could potentially make money on the untested side if the stock decided to roll over. Say, maybe you have 2 weeks left on the contract, and then some, earnings comes out and it's good, and then all of a sudden some bad news happens in the market and we roll over, and the untested side now actually has some value. So you could actually make money on both sides, which is another technique that traders might choose to do, as well as, if you get a move in either direction, instead of just selling that option, now maybe you could sell more of an at the money. If the stock goes from 50 to 60, you might choose to sell the 60 level calls and take in, a decent amount of time premium, and now you have this spread on for a really good price. So there's all kinds of different ways that you can manage this position, and that's 3 of them. But probably the first 2 are the most popular. If you're up big on a position, most traders would probably just take a profit and be done with it. But certainly you have other options.
Yeah, the way you're describing it, when I'm hearing that, it just it continues to drive home the idea that trading options is an active exercise, and it's part of what makes it fun, but also part of what makes it beneficial to portfolios is your ability to make decisions not just at the outset, but as the stock moves. There's a number of different things you can do. It's really conducive to the investor who likes to trade and manage their money actively. So, Ken, we walked through a lot there. Long straddle, the risks, the position management techniques, and all that. Any common or closing thoughts you want to offer to our audience as we wrap up today?
Only that when you're pricing straddles, strangles, when you're doing any kind of options position, and I can't emphasize this enough to people, that you really want to have a good idea of implied volatility and levels. When traders talk about implied volatility or vol, what they're really talking about is prices. So when volatility is bid or volatility is high, you see guys on TV say, well, volatility is really high in this particular security. What they're really saying is the option prices are high. So obviously there's a time and place for every strategy. Not every strategy is going to work, but you want to put implied volatility. You want to have it working for you. So obviously when implied volatility is high, most traders would look for strategies where they look to sell volatility. On the flip side, when implied volatility is on the cheaper end and low, they might employ strategies that allow them to purchase volatility either outright or maybe just put on a spread. So it's really imperative that people understand that price is everything. Okay, price makes or breaks you, depending on what price you put. And having the strategy is one thing, but the price that you put that strategy on is completely another thing. So you really have to have a firm grasp of the level of pricing that you're putting on to set yourself up for the most success for that position.
Yeah, couldn't agree with that more. Implied volatility is very important to track and be aware of to get a sense for options prices. Ken, thank you very much. I know you guys are doing a lot of wonderful things at the Investor Services Desk. If any of our listeners wanted to reach out and contact you, could they do that?
Absolutely. You can reach us at options@theocc.com. We're here Monday through Friday from 8 a.m. in the morning till 4 p.m. Central Time, and we're here to answer any and all of your options-related questions. Together, and in fact, it's funny, we were talking amongst our group that collectively we have over 75 years of direct options-related experience within our team. So certainly we get a lot of questions, and the turnaround on an answer is very quick. And you can also reach out to us on our chat service, which you can find at optionseducation.org. Once again, the chat service is available 8 a.m. till 4 p.m. Central Standard Time, Monday through Friday as well.
It's a wonderful service that you guys provide, and I certainly encourage all of our listeners to take advantage of that. Lots of good stuff today. Thank you very much, Ken, for being my guest on today's segment of Strategy Spotlight.
You're very welcome, Matt. Thank you for having me.
Ready for a little nostalgia? It's time to take a look back.
Let's go back to Monday, October 19th, 1987, otherwise known as Black Monday, when the market took an unexpected and shocking correction. The S&P 500 on this day was down over 20%. If you've been trading the market in recent years or even the last few decades, that may seem hard to believe. 20% down move in one day. For those of you who are more options focused with your data, implied volatility levels for at-the-money index options on this day reached 150%. That's extraordinarily high. Trading activity was so large and order flow was so extensive that electronic systems virtually failed, leaving open orders unfilled for hours at a time. In more recent years, when corrections have occurred, you may have had orders that have been uncertain with their status for maybe seconds or even minutes, and that can be frustrating. Imagine having those orders unfulfilled for hours during the trading day. Now, going before Black Monday, in the preceding days, the market did experience significant declines for a variety of reasons. They are debatable, so I won't get into specifics here, but for a number of micro and macroeconomic reasons, the market was selling off. And in the bigger picture, this was all happening after a period of great expansion throughout the early 1980s and had now evolved into an economic slowdown, so the market narrative was shifting. This particular market crash appeared to be more of a momentum event, extending losses from the previous week, but in a much larger fashion, and that triggered panic selling and plenty of margin calls. The situation was severe enough that the Fed chair at the time, who was Alan Greenspan, made a statement the next day confirming the readiness and the ability of the Federal Reserve to support the financial system if needed. The issuance of those kinds of statements from the Federal Reserve is not taken lightly. Now, what I find interesting is the market reaction on the following days and its performance on the year as a whole, which is an element to the story that history largely ignores. On Tuesday, October 20th, the S&P rose by over 5%. Then on Wednesday, October 21st, it rose by a more noteworthy 9%. Those are two very large increases in the market following the crash. Subsequent trading days and weeks experienced fluctuation and consolidation, and the market did soon settle down. On the year, including dividends, the S&P was still up over 5% despite this historic crash in October, and that's a very good story to tell. Predicting a major market crash is obviously difficult, but the resiliency of the market has been proven time and time again, and 1987 is a great example of that. And that's today's Looking Back.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
An options calculator is a valuable tool, not just from an educational perspective, but also for its ability to forecast. The OIC offers an options calculator on its website. This is optionseducation.org. In Section 10, the Options Quotes and Calculators section, here you can type in a symbol and then all of the relevant inputs, strike price, volatility level, days to expiration, and then calculate theoretical call and put values along with their Greeks. Now, what's interesting about calculators is then you can further change the days to expiration and change the stock price to forecast out in time at different days to expiration what might a call or put option be worth if the stock moves and some time erodes and volatility changes. This helps you give yourself an idea of what an option might be worth under different market conditions prior to reaching expiration. Of course, that's an inexact science, but it's the best way you can try to forecast what profitability or loss might be in your position looking out. Now, this calculator also has the reverse functionality of being able to input a call or put price and then calculate what volatility is associated with that price. This is useful for those of you who do an implied volatility analysis and want to know if the option is at a certain level, what volatility is associated with that, and it can help you make trading decisions. That's the OIC's options calculator at optionseducation.org in Section 10. The Blue Collar Investor is a wonderful resource for investors. This website is thebluecollarinvestor.com, founded by Alan Ellman, who is a seller of options. He focuses his material on covered calls and selling cash secured puts. Alan is a friend of OIC and works with us on many educational events. He also travels the country and gives presentations on selling options. Not only does his website have a strong focus on education with videos and written material, it also has an Ellman calculator, which helps investors decide what stocks they might want to choose to write options against and to determine what profitability they might expect or a risk profile associated with the trade that they're trying to put together. Lots of videos, lots of written education, and a very handy calculator is all available at thebluecollar.com. A very good read is Technical Analysis Explained by Martin Pring. Now, before you do any trade, whether it's stocks or options, you do need to have an opinion on the market and form some sort of a market idea or thesis. Technical analysis is one of those methods, along with others. Of course, fundamentals can be used or other choices, but technicals is at the top of the list. This book was originally published in 1980. It starts with an overview of the financial markets and business cycles, then gets into specific explanations of different technical studies like support and resistance, volume, Bollinger Bands, moving averages, candlesticks. What's really nice about this book is it also puts them together at the end and helps an investor understand not just what these different studies are, but how to use them and how to trigger a trade from that analysis. Options trading tends to lend itself a little more cleanly to technical studies because you can often be more precise in your expectation for how much a stock is going to move or how long it's going to take to get there. That helps you select strike prices and expiration dates. This book can help you understand how to use that analysis and then take it to your trading. That's Technical Analysis Explained by Martin Pring, and that's today's tools, resources, and Goodreads.
We love connecting with our listeners. With that in mind, let's take a moment to answer a few questions on OIC's Wide World of Options Q&A segment.
Taking your questions on industry happenings today, we have 3 good ones. First is, if I want to buy an option during earnings season, should I buy it early or right before the announcement? Well, I certainly can't tell you when to buy an option because it's going to be determined by the investor on a case-by-case basis. But let's talk a little bit about implied volatility before and after earnings. What you will commonly see before an earnings announcement is implied volatility levels will tick higher. This is something investors often notice and bring to our attention. It certainly does happen, but I will caution investors to not mistake that for expecting prices to move higher. For those of you familiar with pricing models and the equation used to come up with theoretical values, just the fact that implied volatility levels go up does not mean that option prices are also going higher. Keep in mind, days are passing, so to make the math work, if days are passing and options prices are staying the exact same, you would still see an increase in implied volatility. So it's not as clear-cut and cut and dry as you might think, but you might see that before earnings a tick higher in implied volatility. After earnings, of course, you get the volatility crash. Option buyers expect that to happen. They know it's going to happen, and what they're trying to do is capitalize on the movement in the stock, which really means they're trying to capitalize on delta, and they hope they can profit to a magnitude that is greater than the volatility collapse. That's the dynamic that you're trying to capture when you're trading around earnings, and from one earnings announcement or one situation to the next, you'll have to determine how early or what the right time is to buy your options. Question 2, can you explain how to calculate potential profit with options? Well, unfortunately, I can't get too deep into the math because what this question really is asking about is a probability of profit calculation, and it's going to be different for every single option strategy that you want to look at. The idea is to define break-even points and then calculate the likelihood of the underlying stock to reach those points and get through them. Certainly, volatility is going to be part of that calculation, but it's going to be different. If you're doing outright options or spreads or multi-leg strategies, the calculation using calls and puts, buying and selling, and putting that all together is going to vary from one strategy to the next. To be quite honest, most investors who are trying to determine probability of profit are going to find their favorite calculator, input their position, and see what that number is. Question number 3, with some brokers offering no trading fees, do you think this will lead to an increase in volatility since traders can trade more? This is a question that is a hot topic around the office. We certainly have all talked about it. Of course, nobody knows what is going to happen, but this is a very interesting time in the industry with the way costs are trading. One thing I do want to point out to investors is that while this certainly applies to stock traders with commissions going down towards zero, be aware of what the options fees might be. Those still might be there, and there might be less trading. But the idea with the question certainly is a valid one. With less cost, might there be more trading and more action in the markets, and might that lead to more volatility? We'll have to wait and see. Who knows? But generally speaking, from an options perspective, more movement of stock prices through more strike prices means more opportunities, and more movement in the market is what we like to see from an options perspective. Thank you all for those questions. I look forward to answering more of them on our next episode, and that is today's Industry Happenings.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at Options Education, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.